Hello. We are going to go over the first segment of liabilities. I hope you enjoy and find some understanding in this. So, first, we want to talk about what are liabilities. I always talk about liabilities like a space time continuum. Probably, I don't know, for those of you who are sci fi folks, may appreciate that or not. I don't know. But what it is that liabilities are present obligations. So today, I have an obligation to make a payment or provide a service in the future because yesterday, in the past, I made a decision. Case in point, yesterday I took out a loan to purchase inventory for my company, which creates an obligation for me today to make full payment of that liability in the future. So past, present, future. It obligates me in the present for something, a decision that I made in the past that I must pay forward or pay fully in the future or provide a service in the future. Because not all liabilities are bound by payment. Some of them could be along the lines of I'm obligated to provide a service or to perform a service for a client based on the liability that was created. To keep it really simple, because this can go many different ways, we are just going to take a look at the two major types of liabilities that we talk about in accounting, and that could be current or short-term liabilities and then long-term liabilities. So when we're talking about the past, present, future continuum here, we're taking a look and saying, okay, a current liability says, yes, today I'm obligated to make a payment or provide a service in the future for something that I did in the past, such as yesterday. But these payments or obligations that must be met in the future are within 1 year, 12 months to 1 year in the current operating cycle or accounting cycle. And we are aware of some of these accounts payable, short-term notes payable, unearned revenue, sales taxes payable, payroll, warranty liabilities, and the current portion of long-term debt. So when we're talking about accounts payable, remember in an earlier accounting course, you would have used, if you were a corporation or a business, you would have used accounts payable to purchase your merchandise inventory. And so that would obligate us to then pay in full to our vendor or our supplier for the purchase of our inventory. Okay. Then we have short-term notes payable. Now, short-term notes payable, remember the term notes in accounting means a loan. Okay. And so short-term notes payable means this is a short loan. It's a loan that we are obligated to pay off within 12 months or less, a year or less. Typically, we see these as 90-day loans, 120-day loans, or maybe 5-month loans, 9-month loans, anything below 1 year, at or below 1 year. Now, there's many different reasons why we would have a short-term notes payable. So, depending on the scenario, it could mean, okay, we owe, so let's say I'm Best Buy, and Best Buy has just purchased 200 laptops from Dell Corporation, right? And so we purchased it through accounts payable. So we owe Dell, let's say $10,000 for those laptops. Well, we have to pay that within 30 days. 30 days is at the end of 30 days, let's say it's today, we need to pay them that. But for whatever reason, we don't have that. So we'll reach out to Dell and we say, hey, we don't have it. Can you work with us? Dell says, sure, we'll work with you. We are now going to change your account to a short-term notes payable. And so short-term notes payable can be used to extend the due date for the accounts payable, giving the company more time, but charging interest for that time. And so that's a type of a short-term notes payable. Then we go to a bank or some sort of creditor or a loaning company, and we take out a note for $10,000 that we have to pay in 5 months or 120 days or something along those lines. So in return, we get the proceeds from that note, the money, the $10,000, and then at the end of the term or the life of the note, we are obligated to pay the note in full, the principal amount of the note plus the interest that we're being charged. So that's a form of a short-term notes payable. Another kind is when we go to our supplier or a lender and they have in-house financing. So instead of going to a bank or a loaning company, we will go to the supplier and they will extend us a note, or we will be able to use a note with them in-house in order to make a purchase. So an example of that would be if I am an attorney's office and I go to, let's say, Rooms to Go, and I need to outfit my office, my facility. So I need sofa, I need a couch for my clients can come in and sit, and then I need furniture, and then I need furniture for the break room, furniture for my office, furniture for the secretary. And so we go to Rooms to Go to get that done. And so instead of borrowing the money from the bank through my business bank account, and instead of any other way or charging to my charge card, or even purchasing the amount on accounts payable through Rooms to Go, I'll take out a note and they'll allow me to finance it through them. So that's another way we can do that. So there's many different ways, and even within the short-term notes payable umbrella, there's different types of short-term notes, whether the interest is due at the beginning of the note when the note is generated, or if it's due at the end of the note when the note matures. And so we'll take a look at that. Then we have unearned revenue. So remember, unearned revenue, don't let the name fool you. This is revenue that we have not earned. So it's really self-descriptive. It's saying, listen, this is revenue that we have not earned, so we are obligated to earn it sometime in the future, past, present, future. So this is for the performers, your favorite artists, your comedian. They're selling tickets to their concert, and you purchase them at the box office. Those proceeds, the money that they receive, is not earned yet, so it's not deemed revenue. It's called unearned revenue. And the artist, the performer, will not earn that revenue until the day of the performance, the concert takes place. Then it's earned, and then if you remember in an earlier accounting course, we would do an adjusting entry for that. So unearned revenue is a current liability. Okay, then we have sales tax payable. So although the company, Best Buy, Target, Walmart, Kroger, even if you're buying a home or you're buying a car, the company will charge the sales tax on behalf of the state and local government. It is not theirs. They have to remit that sales tax they collected from the customer to the government entity, whether that's monthly or quarterly. That's a whole nother conversation. But that is also a liability because the auto the sorry, the auto store or the Kroger or the grocery store or the retail store is obligated to make that payment on the customer's behalf to the state and local government. So that's a current liability. And then we have payroll. And so all of that stuff that is withheld from our paychecks, the FICA and the things that make up FICA, voluntary, involuntary, all the things that are withheld from our checks are considered current liabilities. They're obligations that must be paid sometime in the future, with the payment coming from the employer to said entity. All right. And so we consider those to be current liabilities. They must be paid currently in the next 12 months to 1 year. And then warranties. That's another popular one that we see in a lot of accounting courses where we have to account for warranties. Now, these warranties can sometimes be unknown for various reasons, but we must record them because we are obligated. Best Buy is obligated, Walmart is obligated, the car dealership is obligated, the auto manufacturer is obligated to cover the warranty for that product that was sold. And during the warranty period, they're obligated to make good on that warranty, whether that is to replace the parts, whether that's to fix something or to replace it. That is the current obligation based on a past sales transaction. All right. And then we have another popular one in accounting courses, our current portion of the long-term debt. And so you may have a 30-year note, but what is the current portion, the 2025 portion of that note that's due? So of the payments that are due over the life of the long-term note, what are due in this year? And so that's considered the current portion of long-term debt. So that's what we have as current liabilities. And then we have long-term liabilities. And long-term liabilities are obligations that are due beyond 1 year or 12 months. They're, 3 years out, 5 years out, 10 years out, 20 years out, 50 years out. Okay. And typically, what you will see talked about in this section in accounting courses are bonds or bonds, installment notes, mortgages, and lease liabilities. These are items that are talked about here. Bonds are when a corporation issues, creates a debt package and they issue it out to the general public. Now, that's a corporation. Local municipal entities can do that. So, a college or university could do that in an effort to build a new building or to renovate an old building or to create a stadium for their athletic team. They will issue out a bond, and the you and me's of the world will pay into that bond, and then the college and or university will make those interest payments and then pay us back for using that. So it's like a loan, but instead of going to the bank to get $1 million loan or a $20 million loan, they will make it a public loan where many thousands, and dare I say millions of people can purchase into the bond, which is a form of a loan. It's a long-term liability. And then the entity will make the regular interest payments to the bond holders, people who paid into the bond, and then they will pay them their money back. Okay. And so waterworks, utilities, if your local cities, your counties will do that for the roads or the sewage or those sorts of things. As I said before, colleges and universities, your city will probably do it if they're creating a new venue in the downtown or they're renovating or they have a senior center that they're trying to create. Many local and municipal entities will use bonds a lot. County government, local government, city government, and the likes. And of course, corporations, Disney, a lot of the corporations, instead of going out and getting a loan, they will issue out bonds instead. And there's advantages to that, many pros and cons to everything. And so we'll talk about that later. Then we have installment notes. Now, these notes are typically ones that you and I are more familiar with because many of the loans or notes that we encounter require periodic payments, typically monthly payments plus interest. And so this is what we call in accounting installment notes, because some loans in the business world, installment payments are not required. So I can take out a $30,000 loan that's due in 9 months and not make periodic payments that goes towards the principal, the interest, I just need to pay the $30,000 at the on the maturity date plus interest, so I don't have to make periodic payments. Okay, but installment notes are loans notes where we make periodic payments. Okay, and then mortgages are a type of installment note where the actual building that's being mortgaged is a part of the collateral for the mortgage, and we talk about that later. And then lease liabilities, and this is where a corporation can lease a building or equipment that is used regularly in business operations. And of course, how do we account for that? How, and then there's two different major types of leases. And we take a look at that. All right. We're going to end this segment here. And in the next segment, we're going to take a look specifically at short-term notes payable.